Hi, good afternoon, everybody. Welcome to RBSA's webinar on leadership conversations. Today, we are here to talk about Middle East business opportunities and challenges. For some of you who do not know what Middle East is, the region is defined as countries starting from Iran to Iraq, going up to the Gulf countries, covering Levant, and then going up to Egypt. I mean, that's basically what the Middle East region is. It's unique in the ways that it has 3 or 4 clear buckets. The Gulf region is fraught with 4 or 5 large oil and gas exporting countries that include Saudi Arabia, Kuwait, UAE, Qatar, and they constitute totally between them a GDP of around 1.5 trillion, which is close to about 61% of the Middle East GDP and about 51% of Middle East North Africa. The GCC region is also one of the highest per capita region in excess of per capita GDP of about $22,000 per person. It also has been acting as one of the key hubs for many investors and businesses, which are connected through GCC into rest of MENA, Europe, Asia, and Africa. The other bucket that we talk about is the large populous countries, Egypt and Iran, which are one of the oldest civilizations, as some of us know. The third bucket is Levant, which technically covers Lebanon, which a lot of people call as Paris of the East, and Jordan. And the fourth bucket includes fragile and conflict states that include countries such as Yemen, Iraq, Syria, West Bank, and Gaza. And so these are fraught with economic fragility, security concerns, and conflicts. Middle East is also actually a key entry point connecting the West and the East together through the Suez Canal. As many of us know, Middle East is currently going through what some of us call as double whammy, where it is deeply impacted because of the pandemic, the COVID-19 pandemic. And on the other side, because of the oil prices, the region has been widely impacted. Some of the public agencies have predicted a 4% contraction in economy across MENA or Middle East of about 4% in this year, mainly driven by the lack of consumption or reduced consumption, lower amounts of oil exports, and reduced services in the region. This actually impact on GCC has further impacted the remittances that a lot of the expatriate workers from GCC used to remit out to the other regions, including India, rest of Middle East, Africa, and stuff. So we see 3 key risks in the region. One is the impact of COVID-19 increasing. So it started with Iran, and it has actually spread across the rest of the region pretty rapidly. We see the oil prices to remain in the future almost as low as they are on the lack of demand and reduction in the economic activity. And we see the regional conflicts in Syria, parts of Lebanon, Iraq to continue, and which will obviously have a detrimental impact on the regional economy. Can the region in the medium term sustain this difficult period and still attract investment flows? I think that's a very important question that we all are faced with, especially in the Middle East, North Africa region. And to address some of these opportunities and identify the challenges, we have 3 of the most leading professionals, I would say, from the region. I'd like to introduce you to Mr. Abdul Wahab Al-Halabi, Mr. Magellan Makloof, and Mr. A.D. Ganesh. These are the 3 panelists of today. Let me just share a quick background of the 3 gentlemen. So Mr. Abdul Wahab Al-Halabi, or Abdul Wahab as I call him, has about 24 years of professional experience working in Europe as well as in the Middle East. He has been my ex-colleague, part of KPMG, where he was in 9 years in London KPMG and also part of corporate recovery, and 2 years as a partner in KPMG UAE. In his last couple of stints, he was the CIO of Equity Tower, which is a asset manager which manages 2 large REITs out of UAE, Real Estate Investment Trust. And he has also been previously the Group Chief Investment Officer of Miras, which is a leading real estate company. He's serving on several boards as we speak. I think his last appointment was to a large property company called Union Properties. Mr. Magellan Makloof, or Magellan as I call him, is the co-founder of Cedar Bridge. It's a leading private equity fund based in Middle East, but having focus in parts of Europe, Asia, anchored in Middle East itself. Magellan is a seasoned business and private equity leader. He has got international experience. He holds board positions in leadership roles across industries. Previously, Magellan was the MD of private equity for Gulf Capital, which is another Middle East-based private equity group. Prior to moving to UAE, he has been working overseas. So he was with Johnson Controls in Belgium for about 5 years. And prior to Johnson Controls, he was with General Electric for 8 years, working across North America, and Europe. So truly an international profile in Magellan. And last but not the least, on the panelist is Mr. A.D. Ganesh, who is a seasoned banker, has been with Standard Chartered in different roles. Started his life in 1996 with India, where he started working on Indian transactions, then moved to Middle East. And in the Middle East, and he has grown and worked on different roles based out of Dubai, out of London. So he is currently the head of commercial banking for UAE, Middle East, and Africa. In his previous roles, he was the head of structured trade finance for Africa, Europe, and Americas, and also the head of corporate finance for Europe. So truly a very esteemed panel. And I would just also like to introduce myself just to give the context of why I'm kind of being a moderator on this. So I lead investment banking for RBSA across its markets. Currently working, so RBSA has presence outside of India in Middle East and in Singapore. So I work very closely with our team in the Middle East, which is based out of Dubai. I've been associated with Middle East region since 1997 in different roles. I worked with ENY and KPMG in the advisory capacity. I also worked with Standard Chartered, a colleague of Ganesh at that point in time as a lender. And then with IFC, part of the World Bank Group for over 8 years, investing their money across the Middle East, North Africa region. So with that background and not holding the discussion, gentlemen, I'd like to open the floor, and maybe we could start with Magellan. Kindly, Magellan, give us a kind of your take on the current situation on the Middle East that we see, the double whammy that we are talking about. And also, if you wish, you could probably introduce some of the activities that your fund is currently doing.
Okay, first of all, thank you for your time, AJ, and greetings to everyone watching the webcam. Just for my other panelists, just to make sure it's clear for everyone watching, if you can maybe keep it on mute so there's no background noise or anything like that, just to make it a clear experience for everyone else. So, the main topic I think today is what's happening and how we're dealing with our companies and our portfolio companies across the region. I had my notes ready to talk about, and I think one of the questions that you had later on is about the different sectors and subsectors. I think during this epidemic, you've got the B2B and the government sectors and the oil and gas and these type of things, which have reduced their spendings, and it's driving an impact. With us, Cedar Bridge and my current fund, and I have invested in other funds, we've had more of a consumer focused, and our fund is consumer focused on the B2C. So we've invested more in education, retail services, and healthcare. And I can tell you within those sectors, even with the decrease in social distancing and decrease in the numbers, if you're managing the business on a cash by cash basis, there are some good opportunities that will come out of this. So I don't know if I'm digressing too much, but I've just given you a glimpse on how we're dealing with it, and we've split the way we're viewing the world into 4 phases. So phase 1 is just to survive, and what we've been doing is just reviewing the cash for all our companies on a weekly basis and preparing reports and getting down to minute details on what needs to be done on cash savings. The second one is pushing for profitability by month once we've been allowed to open. So in the UAE, we're pretty much fully opened, and some other regions. And then we're going to grow the businesses. And then the last thing is to focus on exits. So we've kind of switched things around where we usually focus more on exits and more governance and higher levels. We've now had to go to the bottom of the pyramid and build it up. Hopefully that addresses your question, AJ, and I'll be able to cover some more things later on.
Sure. Thanks, Magellan. Ganesh, you would want to cover your take on the region? I mean, broad cover, sure. And then maybe what your activities are in the region.
Sure. Thank you, Ajay. I think in addition to what has been said, I think good afternoon, everyone. I think a few broad themes that I would like to sort of point out. One is we all know what's happening as a result of COVID and likely sort of scenarios, but what's specifically happening in the GCC markets, which the Gulf countries, is a majority of the population is expatriates. So with the sort of reduction in activity levels and sort of governments and banks and other institutions right sizing or downsizing, we also see a population decline happening. If I take the case of say UAE or Saudi or sort of Bahrain or Oman, sort of that's happening because a lot of the foreign workers are starting to leave, and that's unfortunately likely to continue over the next few quarters. Second point is on the so far as the non-oil sector is concerned, their recoveries are likely to be constrained due to the less fiscal space as a result of low oil prices. Because of the low oil prices, the governments don't have the kind of flexibility to be able to spend on the non-oil sector. So that in addition to the scale of population decline, is going to have impact even on 2021 and beyond. And again, added to this is the agreements with OPEC in terms of how much each country can sort of produce. So obviously, even though these countries are rich on oil resources, they're also constrained by how much they can offer in the market. And if you take the average sort of crude price to be around 35, 37 next year, 2020 and beyond, so therein also lies budgetary challenges for all these countries. And some of these countries are pretty strong, but their financial buffers have eroded over the past decade. And sovereign credit worthiness does vary across the Middle East. If I were to take countries, say like Saudi Arabia, UAE, Qatar, these are very strong, AA sort of rated countries. But if I were to take the case of countries, say like Bahrain and Oman, these are obviously sort of much weaker rated and obviously much more vulnerable to what's happening now. In terms of our activities, Standard Chartered is like a full service bank. Sort of, we operate in a lot of these markets. We offer the full suite of products in terms of transaction banking, financial markets, corporate finance, cash management, sort of retail banking, private banking. So we do probably a lot of products, and we also tend to deal with the whole suite of customers, right from sovereigns, multinationals, locally run businesses, so on and so forth. Yeah, thank you.
Thanks, Ganesh. And Abdul Wahab, I think unfortunately you're not visible on the screen, but I think we can hear you. So if you could also have your take, given that you've been part of a advisory team, you've been on the other side of the table, very closely working in quasi-governmental institutions. If you can also share your perspective on the region.
Yeah, thanks, and apologies. First of all, good afternoon, everyone, and apologies that you can't see me. I'm technologically challenged. I think it's me more than the machine, but never mind. My take on the region right now, in a broad level, and I think we'll do some specifics later. A lot of my interests are on the transitory nature of some of the countries we're in. So, for example, I chair the board of Dubai Parks and Resorts, which is the largest theme park business in the region, and I'm involved from an advisory perspective very heavily in the hospitality sector. As well as an investor in some of those. So we see a need, the region needs outside world. It's very much a region that kind of takes in capital and people and goods from other parts of the world and transmits them onwards. So the impact on tourism is profound. And I think we've lost not 1 year, but 2 years at least, because we will probably lose the next season of good weather here, which is winter for most of the rest of the world. That means we need to tighten our belts to Majal's point about phase one, hold on cash. Hold on cash is not going to be a few months, it's going to be a couple of years, I think. That means also that there will be a large amount of supply taken out of the market. A lot of the region has entered the COVID crisis already a little bit weakened. So the GCC countries were already suffering from a number of other factors. Many of them were in some form of recessionary environment or another. And all of a sudden, this hits. Now, this actually, for me, presents opportunities as much as it's got challenges. For those that are able to survive this next 18 months or so, there will be so much less supply out there that maybe the supply-demand imbalance will have been rectified. Notwithstanding what Ganesh said in terms of population decline. Yeah, population is declining, but and therefore demand is. But if supply drops even more, that's better. Do we believe, or do I believe, that the need for tourism, the need for travel will be eliminated? I think there's a lot of doom and gloom that's been talked about, and a lot of people thinking the world will change forever post-COVID. In the same way that we all learned to live on Zoom and WebEx and I don't know what within a week or 2 weeks of COVID, I think we will unlearn those lessons as quickly as we've learned them. In some countries, particularly the UAE where I live, where it's opening up, I'm already seeing demand for people saying we must meet in the office, we cannot meet on Zoom. And
Sure.
so I think to some extent we will find that we will unlearn some of those lessons. We'll go back a little bit to normal, and has positives and negatives, but that's a positive thing from generating demand. Supply will be eliminated severely because I think you need to hold out for a lot longer than people think. The financial systems, as Ganesh had mentioned, and Ajay as well, actually are relatively stable. Some countries more than others, but in general, there is liquidity in the system. We're seeing liquidity. We're seeing transactions right now, even in this world of April, May, June. And so we're hopeful that with the right investment, cut out in supply, and some attempt to manage demand, and perhaps a return to travel. Again, on travel, I don't believe that people will stop traveling. Experiential travel will come back. Perhaps business travel will cut down, but people will always want to travel again, maybe not next year, but the year after. So I'm optimistic medium term, but I think that we need to tighten our belts more than we've ever done before for the next 18 months. That's my take at the moment at the macro level.
Sure. Thanks, Abdul Wahab. I think the common theme between all the three of you is that things are not as bad as it appears to be. I'm sure the region will find its own way to find growth in the coming, probably, if not weeks, probably months, or maybe a year or so. So I think that's really heartening to know. Moving on to a specific question to Ganesh. So Ganesh, you cover a very large region of Middle East and Africa. So could you just share your sense of how do you see Middle East actually gaining from the cross-border trade and investment flows that it has, sharing with Asia, parts of Europe and Africa, given the current scenario or otherwise as well?
So even before sort of the COVID started, we were already seeing the sort of impact of the US-China trade war and the sort of associated likely fallouts. To give you an example, a lot of companies were trying to sort of start supplying from outside of China and diversify supply sources, the manufacturers also. With the result, Middle East does stand to benefit and can benefit. I can sort of, without taking specific names, we have a large float glass manufacturer out of Bahrain. Sort of now that's also owned by a Chinese company to a large extent. But again, they started billing from Bahrain, manufacturing and billing from Bahrain and supplying into the Europe and US, where sort of you're not subject to quota restrictions or punitive tariffs. So those sort of things have started to happen. Probably they will start happening more. The UAE and the Middle East can benefit as a midpoint in terms of supply sources, as companies obviously look to either diversify their supply sources, or some of them look to even reshoring. That's the common phrase which is being used these days. Even sort of each company will have to make its choice in terms of how much additional, if at all, I'm willing to pay, sort of. But I need to have more diverse sources rather than relying on a single vendor or a single country. Those discussions have started happening, and Middle East does stand to benefit. But again, they will have to be cost competitive, both on the infrastructure side and also the ease of doing business, which I believe definitely is the case. Specifically, talking about places like say UAE or Bahrain, they're quite easy to sort of come in and do business.
Sure. Thanks, Anish. I think a related question was, I think a lot of the financiers are presented now with more riskier opportunities. In this kind of a scenario where banks have pressure to continue to at least, deploy their funds, your strategy would be in terms of looking at a larger number of customers, or would you look at increasing the wallet share in the existing customers in view of the risks that are presented? I mean, would you want to spread your exposure a bit wider, or would you like to look at good exposures and exiting the ones which are, I mean, I'm not saying as Standard Chartered, but in your view as bankers, what do you think is the approach, the right approach in this scenario?
See, first, from a macro perspective, I think interest rates are pretty low, and they're likely to stay low for the foreseeable future. You can take your bet next 12, 18, 24 months, at least till the end of 2021. I would like to believe that interest rates will remain very low, and therein obviously the yields on fixed income will also be substantially lower. or next to nothing. So there is lots of pools of capital which are waiting to get a decent yield, private capital. So people and pools of capital and liquidity are there. So they will be they're waiting to get deployed, whether sort of whether it is funds or even banks sort of. So there's no magic solution here. We will just need better structuring of transactions, better mix of debt and equity, and more sort of importantly, a more realistic demand outlook. Because what used to happen, when we used to do projections, say, whatever, till 6 months ago, is going to be very different from how we look at things now and sectors now. See, there are sectors which are benefiting. There are sectors sort of, the obvious ones being travel, tourism, airlines, those are the ones who have been badly affected, high-end retail. But having said that, again, within each sector, there will be companies who will come out winners because they are, more liquid. They have a stronger capital base. They have the capacity to absorb the smaller players. Sort of, they can gain market share. Like Abdul Wahab said, if some companies are going out of business, but still the demand is not going to fall that much. Somebody else needs to be there to supply that. So there are going to be consolidation opportunities. So those are the ones obviously sort of we will be looking to back, and generally, the financial system will be looking to back them as well. So I wouldn't say sort of certain sectors are not to be touched, but again, we got to be much more careful than what we used to be in the past, especially in terms of assessing how the future demand is likely to look.
Sure. Thanks, Ganesh. And I think coming to sectors, Magellan, you mentioned that you are currently looking at, or your own funds are deployed in a lot of the consumer B2C themes. I mean, traditionally we have seen a lot of the large funds, where they call them as sovereign wealth funds or pension funds in the region, have heavily invested on businesses backed by hydrocarbons or supporting construction and infrastructure build activities. Some of the private equity funds have also been looking at property and tourism sectors. And as Abdul Wahab said about some of the decline that we see in property and tourism sector, and your already existing focus on consumer, where do you see, somebody like you would look at, which sectors would you look at which are possibly economically resilient? I understand health and education is already a bit resilient to any kind of downturn, but given the flight of a lot of the expatriates from the region, what are your pick of 2 or 3 sectors which can survive even this kind of mayhem?
Excellent questions. The way I'll answer it closer to the end on the specific subsectors. But if we go back to 10,000 feet, what this crisis has shown me, and investing in my last 4 funds and going through crises in 2008 and other things, is it keeps on reinforcing a portfolio approach is the best approach, because you don't know what sectors are going to do well in certain circumstances under certain stresses. And also, when I know you were focused on the region, but also portfolio approach across regions, because different regions have handled things a bit differently. So I think that wanted to address that. A subsection of that is when you're if you're coming from an angle of investing in funds or investing in teams, there was a study done by Cambridge on the private equity side that sector-focused funds do much better than generalist funds. And the reason for that is they understand the subsector and all the rules and regulations. And with current crisis, I think this is even emphasized more, that the groups and entities that are in a certain sector will do much better because they'll be able to navigate through this. The study showed that funds below 250 million did about 2.5 money on money versus 2 on a generalist fund. So sector specific did 2.5, with the general fund did 2. So I wanted just to address those on, let's say, about the whole overall theme about sectors and subsectors. Now, to your question regarding, which sectors would be good through this change, and if we go back to what some of the other panelists mentioned about how quickly things are happening, and then also the change in the shift in supply and demand, we are very bullish on the consumer sectors, but the subsectors, from education, retail, and healthcare. And I can give you just a few case studies on why. So on the education sector, we own the largest media university, and we haven't, felt a major impact. Obviously, we had to shift to online, we had to shift the students, but this business and the numbers and what we've seen hasn't been impacted. Now, and there's some pluses and minuses. There's going to be some minuses, as mentioned earlier, that you have a reduction in the expat community, but then also you have a reduction of students that were going to travel outside the region or normally travel out the region. So it's starting to balance out. Another business that we have is the largest language institute, Eton. In that particular business, we completely shifted the business online, and we use this as an opportunity to work with corporates to move them online, which we weren't interested before in other businesses. So education, we're very positive about. Retail services, I've never been positive about FMB, and I've had arguments with my co-founder and partner for the last 10 years on avoiding FMB deals, and I think I've been right. This sector, I think, is really going to be challenged. But then something to emphasize is there's subsectors within sectors. So on the FMB side, what you call casual dining, I think will be really challenged. But the QSR and the takeaway slash that end will do well. For example, if you look at some statistics in the U.S., there is one of the large chicken businesses. Their average ticket went from $8 to $20 because people were going in and buying family packages and things like that. So I think there'll be some subsectors that will do well. On the retail beauty side, which we invest heavily, you can see there's been queues of people going back to getting their haircuts. You can't outsource that. So I can go on and on examples, but I think within the consumer businesses, there are some very positive themes there. And then within the subsectors of businesses, one needs to go and take a look at it. But overall, if there's a fund that is sector specific, they'll help be able to navigate through that. So hopefully I've addressed that, AJ. Thank you.
Thanks, Magellan. You have, and the next question is for Abdul Wahab, where a lot of the sectors that we see, say agribusiness, or we see health and education, in the medium term are moving towards technology-enabled models, as Magellan and other colleagues also mentioned. We have an agri-tech approach to life. We have a health tech approach to life. Coming to leisure and tourism, and Abdul Wahab, your involvement at all levels within that industry, how do you see, or what would be your maybe 1 or 2 point recommendations to resurrect this through some kind of a government involvement, or some kind of pools? So is the approach what would be the approach that you would suggest say governments in the region to take to resurrect the leisure and tourism in the medium term?
You mean in terms of government support? So I think
yes,
the largest.
Yes, I mean it could be it could be monetary support, or it could be also physical, because you need to be physically available to use these services.
Yeah, I think the central governments across the region, and the area in particular where I'm heavily concentrated, have been supporting, but the support that they can offer is very limited. They can't print money like some of the larger economies that have independent currencies can. So that is something that's difficult. The governments are being supportive in terms of reducing taxes and fees, and that needs to continue. But the real differentiator, but that won't move the needle either, because taxes are there, but they're relatively low. The thing that will move the needle is what can the government do to bring people and bodies into the country. And I think that part of that has happened with the support to the airlines, both Etihad and Emirates in the UAE, and I believe in Saudi as well, where they're trying at the moment, or they're planning. I know they're planning to upgrade and enhance the airport infrastructure of the country heavily to make it easy to come in. The government can support by making it easier for people to get in and out of those countries. The UAE is a very open countries, but Oman, Bahrain, Saudi still in particular needs to do a little bit more to help people come in and out easily. Visa restrictions and other restrictions that exist in some of those countries. And the number one and biggest, most important thing is marketing, to be honest, because people will travel, and you've got to market our countries as safe places to be in. Dubai has won a lot of plaudits, so has Abu Dhabi in terms of its handling of the pandemic and the way safety was. The government has been extremely rigid in its enforcement of social distancing. Those of you who live here or are stuck here actually are probably happy to be stuck here compared to some other countries. So that side of it is really where the support comes in from the government that can help survive this period of time. At the moment, the other thing that is very critical is something that was pointed out earlier. We rely a lot on expat workforces and talent. And at the moment, most GCC countries are somewhat restrictive in terms of visas, residencies, work permits, and so on. And loosening those, slackening those, and allowing a more mobile, if you like, workforce, and a more making workforces more variable and easier to handle is extremely critical. This has been done during the actual extreme end of the crisis. When we were in lockdown, furloughing laws were done, wage delays were done, and the service benefits and other pension type benefits have been delayed by many countries, and labor laws were changed temporarily. These changes, some of them have to become structural. They need to protect employees, we understand, as employers, but they need to be done in a way that allows a more flexible workforce, because the entertainment industry and the tourism industry is very, very labor intensive. And indeed, in some cases, it employs a large percentage of the workforce here. As Majan will probably testify, he probably has a lot of film pieces in his beauty lounges and the other consumer-driven stuff. So sure, that side of it will be extremely critical. Going forward, I think regulations on future investment and trying to control supply and demand, I'm against it personally. I understand that governments do it regularly in terms of limiting supply, limiting building permits for new hotels, for example, and so on. I believe you should let the free market decide for itself, but you should make it easy for the free market to decide. So if a hotel wants to become a service apartment building, so be it, let them be. That will help the hotel industry and probably help other sectors as well at the same time. So this form of support from governments, I think, is super critical. And all these things I mentioned are not monetary. They're tweaking and changing laws and regulations to make it easier for us commercial people to make money and survive this crisis.
Sure. Thank you so much. And so I think I had a question for Majlan, but probably just continuing with you, Abdul Wahab. So I think a related industry to leisure and tourism, which I think the region has really well exploited, which is the real estate sector, property sector. There, I mean, I think what we see is all types of properties. So you have mixed use properties which have been constructed. You got leisure and tourism kind of properties, large parks available in the region. You have some parts of religious tourism also being inducted because of hotels built and stuff in some of the countries. So I just wanted to hear your views on I think in the medium term that infrastructure creation through real estate build is obviously going to help the region as being a hub for these kind of activities. But how do you see that happening in the mid say next 1 to 2 years? And a related thing, you've also been associated with the real estate investment trust, Equitativa, when you were there. And so I think your experience on success of some of these capital markets interventions like REITs, I think Middle East was one of the early regions in Asia to have REITs successfully implemented, and we've seen it being successful. So do you see to really expand the scope of real estate activity? How would you suggest, what would be the plan to increase the number of REITs? I mean, currently we have 2 REITs sitting under Equitativa, and I'm sure there are some others on the drawing board. But my 2 key questions: one, what is your take of real estate in the next 1 to 2 years? And second, what kind of mitigation does REITs provide as a capital market solution to the so-called difficult period in the real estate industry at this point in time? So these 2 questions, Abdul.
Sure, thank you. I'll talk about real estate generally because that's a pertinent point and a very popular point. As the panelists and many of the people on the call will understand, real estate has been a big driver of GDP growth in the UAE, in Bahrain, in Qatar, and to a limited extent in Oman over the last 15, 20 years, and constituted a big chunk of GDP when you take into account all the associated activity with building stuff, be it hotels or roads or airports or residential. And we've had cycles. So we've had the 2008 crisis where there was oversupply. We've had 2001 crisis for those that remember that. And indeed in 2016 to 19, to be honest, we've had a softening of demand for real estate in all its forms. Yet we continue to build. And that's created more softening. I think we're at the stage today where 2 things are happening. Sorry, before I enter into what's happening today, Saudi is the only exception to this. Saudi is opening up and coming out, if you like. So they've probably got another 20 years of building to do before they reach a certain level, which they're happy with the status of their infrastructure and their real estate sector. So I put that bucket aside. But today we're at a stage where there are two things happening in the more developed, or sorry, from a property development perspective, more developed markets. They are that there are structural changes happening. So for example, and we hear about this globally, office space is going to change in the way it's used, and the markets need to react to that. When we hit the 2008 crisis, we had an oversupply of 150% in office space in the UAE, and in Dubai, most of it was in Dubai. Today, we don't really know. Offices are still shut. I sit in the DIFC at this minute and it's empty. And we don't know what's going to happen, and we don't know if it's ever going to come back. So there are structural changes that will happen to some of these buildings that we need to understand. The hospitality sector and the way people live are also changing. The more people work from home, the more they will need different types of homes. It's easy for those people who had separate rooms to work from to say, oh, Zoom is fantastic, I'm much more efficient at home. But if you happen to be a young person sharing an apartment and you've got one dining room and two small bedrooms, it's not so pleasant. And we've seen this in more developed countries where people move out into the countryside. We don't have many countrysides in this region, but some format of that is going to change. So these structural changes will come through. In terms of overall supply demand, I think clearly demand is dropping. Overall residential, commercial, and then retail as well, obviously, which was already suffering, and hospitality too for the next couple of years. So in the next 1 to 2 years, if you ask me, Ajay, we will see almost no activity in real estate except conversions into something more adaptable. I think in the next 5 years, I will see very, very limited development going on. 10 years onwards, who knows where we'll be, except in Saudi, where we're going to see, I think, continued investment, because the country, I think one of the country's lucky in that one of the tools it has to get itself out of the current rut that's happening with lower relatively oil prices and the COVID crisis, that it can build its way out, using proper Keynesian government stimulus to dig itself out of this. The other countries in the region don't have that particular tool. Now, people will say building for whom and for what? And I think with a country like Saudi, which is so hungry for so much, I think there's still demand, pent-up demand and scope for them to build things for people to come and do things in them, be they tourism projects or indeed rejuvenating their commercial sector and indeed their residential sector as well. I hope that covers kind of views on real estate generally, Ajay, if I go into REITs. Are there any questions that come up?
No, I think that's good enough. Yeah.
So on REITs in particular, REITs, just as a background for those not from the region, there are 2 listed REITs in the UAE. There are 4 or 5 private property funds that we're looking to list as REITs. And then there's about 15 to 20 listed REITs in Saudi Arabia and a number of other property funds, many of them over there. And that's pretty much it. REITs as a mechanic are a good way for risk diversification for individuals, obviously, because they invest in a fund at the unit level, which is relatively small value if they want, and they get exposure to a wide range of real estate classes and assets, number of assets as well. The challenge we've had is the markets haven't really adapted to them very well in the UAE. We've seen very limited success in the pricing of REITs once they were listed, the 2 that are listed here. We've seen a lot of difficulty in terms of attracting people to REIT from large institutions. Large institutions prefer to touch and feel. Smaller people found shares illiquid. Regulations are not yet there. The 2 REITs that are listed in the UAE are on NASDAQ Dubai, which is not a very liquid market. The main markets haven't yet adopted full regulations for those. If you look at Saudi, which has been much faster in adopting its public market regulations for REITs, there's been an influx of capital, and that's why there are so many REITs over there. I think there's more scope for those to be a tool for future development, perfect in Saudi, which is developing. So somebody will take development risk and offload all of these assets that they build into REITs probably, and by then hopefully the market's bigger. Now, as with all things when they start, it's fragmented. I think there are too many REITs in Saudi and each REIT is too small, but that's fine, because in 2 or 3 years when there are more assets to come on, we'll probably see consolidation and we'll probably see specialization. So you'll have hospitality REITs, commercial REITs, retail REITs, and so on. And it will become a much better tool to become an offtake for developers in the future where you're developing. In other markets, they're smaller, and I think the one lesson I've learned is that you need very deep, very big markets for REITs or collective investment schemes in property to flourish. So I don't know to what extent they will be successful in the smaller countries. That's kind of my 2-minute overview of that.
Well, thanks, Abdul Wahab, and great insights about Saudi versus UAE in REITs and overall on the real estate sector. Magellan, I think, as I understand, Cedar Bridge, the firm that you currently represent and you founded, has had tremendous success in terms of its exits in the past. Those were the times when obviously there were a lot of takers of, good assets. I know the investing style that you have in terms of creating, nurturing those assets, and then kind of exiting. Even when you buy them, I think you maintain relationships with them. I think great style of private equity that you follow. Given the situation currently, and when I talk to, we advise a lot of people to invest into the Middle East region. The general notion that a lot of the outside investors has been one, geopolitical risk that they kind of over-assign to more stable countries like GCC at times. For them, everything is Syria or everything is going off next minute, which obviously is not true. Second is in terms of now the double whammy that we talk about. Do you see the typical exit mechanism, which used to be trade sale in most of the cases for private equities? I mean, unless you talk about very large investments, I mean, most of them actually exit through trade sale. Some of them do private, IPOs as well. But how do you see that changing in the next maybe couple of years for private equity, maybe yourself or the others who are coming up for exits? Would that be impacted? Is there any other way to manage this risk? The reason I ask is also because I have some friends who run private equities in other parts of Asia, and they've had to actually take out their LPs, and they were just not able to exit their investments on time, and their fund duration was over. So they had that risk of actually not being able to exit in time. So what's your take on an exit risk in the current scenario for the funds?
Okay, well, thank you, AJ, for the way you've introduced this subject on exit. So your comment about our success on exits, one example just for the audience, and AJ is familiar with it, is we used to own the largest group of kindergartens or early childhood education centers in the Middle East, and we exited that at 6.5 times money, which was a fantastic exit. But if I reconcile that with your comment, AJ, is the group that we exited to was a group or similar groups we had been talking to from the day we bought the business. So you always think about your exit the day you close, you buy a business. And we were grooming and chatting with these groups, and it ended up being the largest owner of early childhood education businesses in France. But we were also chatting with the group in the UK and a few others. And you work on these exits, as you move forward, and always focus on them, and then adapt to whatever the ultimate buyer wants to have. So as a data point. Now, that said, is turning it on its head is exits today, during this crisis or during this, let's say, this moment of change. It reminds me of a quote from a BBC show, which I've never seen, but I've heard the quote so many times, called Faulty Towers, which says, "Don't mention the war." So this quote about "don't mention the war." So my quote for today is going to be, "Don't mention exits." So right now, we're not talking about exits, and we're going to be focusing on the business and what needs to be done to the business. And if I reconcile that, what I said earlier is you've got to make sure your businesses are rock solid and they get through this business, this time, and then grow. And the most important thing is to show what you're doing different than others, and then you'll be valuable. So one of my first managers at GE told me in the 90s, success brings success. If I reconcile this back to what Abdul Wahab said earlier about what Dubai's doing and how they're doing a great job on tourism and marketing and things like that, that is the most important thing, that you have to show that you're doing something different, and the whole world has to see that. So I can give you a case study. In Europe, we own the largest group of Costa coffees, 30 locations in Cyprus. And I was speaking with the head of Costa, asking them and trying to learn what they had done in China. And in China, they have 1,000 locations. And I said, what can we do? And they've said they've tried everything. They tried heavy marketing. It didn't impact certain stores. They tried heavy discounting. It didn't impact certain stores. The only thing that impacted those stores, and I could reconcile this to countries or businesses, is if the consumer saw something that was physically changed. If a consumer walked into a store and there was normally 50 tables and they saw 20, if they walked in the store and they saw, sneeze guards and all the staff with masks and things like that, they then continue to go to that store. So I'm emphasizing this showing that you've made a change and you've transitioned properly will help you with your exits, and then reconciling it back to about tourism in Dubai. I truly believe that Dubai is going to be one of the few and within the global view that can really show that they've done a major change and are doing things differently. If you compare it to how the European countries are opening up in tourism, there's not that much of a change. So that's kind of how I overall link this together and talk about exits. So over to you, AJ.
So thanks, Magellan. So I think one of the key themes probably in the region currently everybody is worried about is the stressed businesses. Talk about the local businesses, large businesses which are under stress, the small and medium expat-owned businesses which are again under stress. And naturally, when you are having a medium-term view which is not very positive, you tend to offer your businesses at sometimes at discounts. Now, I know a lot of the other regions, including the wider Asia, India has a lot of stress investing that is happening by buyout funds, by stress investors. How do you see, a lot of the private equity funds or the sovereign wealth funds have been used to funding growth capital and growth businesses in the past. Do you see private equity funds like yourself, which take buyout positions already, to get attracted towards taking stress businesses? One, because they're available on attractive valuations. Second, which is a limiting factor, is the ability of some of these private equity funds simply not just to ride on the existing shareholders or promoters, but to be able to actually administer some kind of turnaround. So what's your sense? One, from an opportunity perspective, and second, from the ability of private equity funds in the region that you see investing into the stress businesses.
It's a good question. I think what's different in our region versus, let's say, Europe or North America is when you do have a stress situation, the stressed assets are still owned by an individual who's trying to let's say, exit. In other jurisdictions, they're usually passed to administrator if they are going to bankruptcy and things like that. So the best way to negotiate a deal, and the best deal is through an administrator who can be an advisory firm or an accounting firm, and you're going to get a good deal. Continuing to negotiate with an owner in the region is complicated because of the mixed expectations. So the way we view the world is there are going to be opportunities, but the owner's expectations are going to ensure there's not going to be that many opportunities that can close. So I would turn it on its head and I would reword this. Instead of stressed businesses, I would reword it as stressed parts of businesses. So there are businesses that we're already looking at now that are businesses that we've already invested in. The sellers want to exit, but we know we're not going to be able to negotiate with them. So what we're doing is we're trying to either buy parts of their businesses or locations. And if that fails, without getting into too much details, X business has, let's say, 20 locations. We're speaking to landlords of 7 of those locations and saying, we understand this business is under stress. As soon as it's feasible for us, we're ready to step in at these terms. So we're proactively circling these businesses and going around them. So I'm just answering your question regarding total businesses will be a bit complicated. Parts of stressed businesses will be easier, or picking up the pieces that are left, we're 100% ready, and we've been proactively looking at all our portfolio companies and doing this. Then the second part of your question is how to be able to run them. I'll reconcile it back to my earlier point. If you have a sector expertise, you've got to make sure that you have that, understand that, and know the details of that sector. Then you can easily go in and make the right decision and turn those businesses around. The final point that I want to make, and just give as a case study, is, and it kind of themes to what everyone was saying earlier, is during these times we have to challenge all the assumptions. There's no assumption that the whole world has changed. You know what I mean? So we have to challenge assumptions. So I give you a small example. We own the largest group of yoga centers in Dubai. And I had a discussion, but it was a tough discussion with our general manager, who I said we should move online. And the discussion was 0 chance all the teachers are doing everything free online. 36 teachers also said zero chance. So it was me against 37 people who all said no. I said, no, switch it online. And make a long story short, the business grew online because they had a following. And a good portion of our business now is online. Once the studios were opened, we then had a new model where we had 3 options. Before COVID, it was only the studios. So now we have studio, we have online, and we have a hybrid where you can be in the studio, but it's cast online, and there's sometimes half are online, half are in the studio, and the teachers are the front of the class. So to that point is be ready to challenge every single assumption until to date to be able to drive those businesses forward. But you're more comfortable making a challenge if you really understand the subsector. So over to you, AJ.
Thanks. Great answer, Magellan. Ganesh, in terms of a lot of the regional and international banks, particularly in the Gulf region, are now facing a situation of increased number of NPAs, as it's a widely known fact. It has triggered probably a bit earlier than COVID, but it is now likely to increase further. Typically, what I have seen as an advisor in the region and also being an investor in the past is that there are 2 clear buckets currently people put any kind of resolution for NPAs. One is that you do a refinancing, so you find a group of banks which can take out the existing banks. I don't know whether there is a concept of discounted debt exists yet, like how you have in some of the regions where banks are ready to offer one-time settlement to debt funds. Second is you typically find a buyer if the promoter is still around, if it's not an expat who has run away, then you typically talk to the local owners and try to get another buyer. In the current environment, both of them have obviously become difficult. In your view as a banker, do you see any other alternative mechanisms that probably can improve your recovery? Are there, and when I say your as in a banker's recovery, I mean, it's not NC in particular. If you can just throw some light in what's your take on improving, such stress situations.
Yeah, thank you. I think we just need to take a step back and see as to why some of these problems are also, coming up in the first place. I think with the, a lot of these economies are driven by sort of oil-related revenues, and with the falling oil prices over the last few years, countries are running quite a bit of fiscal deficits, and they are challenged. So projects which were sort of set up with an expectation of X amount of revenues and oil price, sort of when the revenues aren't there, the disbursements from the governments or the state-owned enterprises, or SOEs as we call them, that gets delayed, and then that affects the entire chain along the way. If the main contractor who works for these projects is not getting paid, they're not able to pay the next in line, the subcontractors, and so on and so forth. And then it triggers the chain of defaults. And again, some of the international banks like us, our revenue recognition and sort of ECL and provisioning policies are a lot more stringent now with IFRS 9 being in play. So obviously, sort of we are forced to, or we have to recognize, the stage 2 level of sort of impairment or the stressed asset sort of. So it is challenging, and there is no sort of magic solution here. I think first I would say bankruptcy regulation needs to get better across the region. Frankly, the UAE tried to sort of come up with some sort of a mechanism, but it hasn't taken off, frankly, that much. Secondly, again, we need to plan for these projects or plan for some of these financings properly. Do not use short-term funds for long-term purposes, because we're just kicking the can down the road, and sooner or later the problem comes up. Just by refinancing doesn't mean that sort of we are out of it. We're just kicking the can down the road. There needs to be proper public-private partnerships. What do I mean by that? If a project is going to sort of repay, say, in 8, 10, 12 years, it's not the space for commercial banks to play. Ideally, sort of ECAs should come in and do the bulk of the financing, export credit agencies. The commercial banks can do the residual portion, the 10-15%, but the bulk of it has to be done by long-term financiers, sort of who have the necessary sort of liquidity in terms of long-term. So a lot of things need to fall in place, and lastly, the banks need to act in unison as well, because of the lack of a proper bankruptcy or a Chapter 11 sort of equivalent sort of system in the Middle East. Generally, banks do not sort of act together. Even if there's a company which is having difficulty, and 4 out of 5 banks are happy to extend or restructure, if the 5th bank doesn't do it, then nobody can go ahead. And then what tends to happen, the kind of pressure that exists in some of the markets, that check bouncing is a criminal offense. Some of these promoters tend to take the next flight out, and then sort of then nobody gets a solution, and it doesn't help anybody. But unfortunately, that's still the way it is.
Sure, thanks. So I think thanks Ganesh for a fairly interesting answer, because that's actually led me to the segue to my next question to Abdul Wahab. But Abdul Wahab, I think you, as I know, have been involved in restructuring in some of the developed regions in Europe as part of your KPMG London stint. I have ever since moved to India, have also seen an kind of a bankruptcy code that has emerged in the form of IBC, where we see a lot of resolutions happening. The process is emerging. Yes, I think you have still a lot of teething problems, even if it's 3 to 4 years hence now. But there is something in place, and I think promoters on one side are behaving. The creditors are feeling more comfortable because businesses are not dying. I think they've been taken over by, either buyout funds or other strategics. Abdul Wahab, in your experience, the wealth of experience you carry from your developed country experience, and also knowing some of the businesses in the region, what would be your take on how could a sustainable and implementable kind of bankruptcy framework be developed? As Ganesh said, and I think some of us know, there is something the UAE is doing. There are other countries also doing it in bits and pieces, but effectively people are just scared of issues like criminal offense on one side for expat businesses, and on the other side, I think local driven businesses don't get much because of things are kind of hidden under the carpet, or people are shy about talking about business failures. So with that in mind, I think, and the more important part is that till today, I think past the NPA levels were fairly low, but I think the kind of, somebody was estimating to me that UAE itself could face over $200 billion of distress situations coming to the market, and that's sizable for the government to take note even within the UAE. So my question, Abdul Wahab, sorry, I've given a long prelude to the whole question, is could you give us some pointers for the viewers in terms of how to create a bankruptcy framework as your wish list or your thinking, especially in the GCC region?
Yeah, thanks, Ajay. I'm actually involved right now in 3 turnarounds. 2 are mega restructurings, both of which actually stand chartered with major exposures to them. One is a regional business, and it's large. It's in the, let's call it billions of dollars, if you like, of exposure to the group of banks, and it's currently being restructured outside of a process. I mean, problems happen, right? Yeah, we should plan better, but problems do happen. And what we found there is there's a lack of process for this one that's applicable. It's difficult to apply a bankruptcy process for this particular situation. And what we found is the consensual grouping and clubbing of banks getting together is always the most effective way of any turnaround. Now, in this case, the only reason the banks are all behaving themselves, because as Ganesh said, you have 4 banks doing well and then one person piping up saying no, is because exposures are so large that it's too significant for all of the banks not to play ball. And there I've found that to be always, and in my experience as well over the years, is always the most effective way of enforcing a restructuring. And the second situation, which is also very, very large, the creditors were at ill ease with the debtor, with the company. And there they needed a process because there was too much lack of trust. And what we found over there is that, notwithstanding that we currently have a UAE bankruptcy code, and many countries are trying to apply the same, they are untested. We're not clear how the legal process will work. We're not clear what the judges are going to do. We're not clear about, and insolvency is more subtle than normal commercial law. Where is the debtor in possession? Are they able to continue to run the company? Under what rules? Do you put in a trustee? What powers does a trustee have? How can you bind creditors in? And so on. You can write all of this down on paper, which they did. But then you've got the complexity of jurisdiction. So companies generally have large ones where there's a major restructuring going on, several jurisdictions. So in this one case, we applied a Western insolvency process to the company, and that didn't apply in one of the regional countries here. and the court said, we don't recognize that insolvency process, and this current entity exists and is still upstanding. What do? Some of those entities have access to offshore zones. So in the UAE, you've got ADGM and the IFC who have their own bankruptcy laws. Each one has its own. And will they recognize an overseas insolvency process? Will they try to apply their own? And if they do apply their own, is that forcible onshore in the UAE? And it becomes a complex web of different types of insolvency processes trying to compete for fixing a company. You do need a bankruptcy code. You do need a strong bankruptcy law, because without that, creditors don't have a stick and they don't have a backstop. Without a backstop, a lot of large distress situations will continue to exist. I don't want to name them, but just a quick Google and you'll hear about the last few in the last couple of years that have happened here, where overseas processes were used and so on. This happened as well after the 2008 crisis a few times, with notable ones like our Capita and Dubai World, where there was a special tribunal in place. But having said this, it also probably makes sense not to reinvent the wheel. There's a lot of nationalism around every country having its own code because they say we have our own intricate laws. It's probably sensible to try and apply or allow the application of a Western insolvency code over here, or at least allow enforcement. I know it's controversial, but it does make sense, because at least you have a code that everybody knows. It's tested, the courts have been through it. It's seen as fair. Generally, the 2 or 3 that are globally applied are seen fair. They help creditors have a backstop. People know what to expect and what to go through. And debtors also know what their obligations are. And so I think that the development of bankruptcy law, in summary, in the region is nascent, will continue to be nascent for many years, because until you test it in the courts many times over many years, you're not going to get there in terms of a generally accepted bankruptcy law. And you'll end up having this hodgepodge of overseas bankruptcy codes being applied. For smaller situations, we do need a more rigid process which are only intra-country, but in the context of what we're talking about, or perhaps at the level of, say, a Standard Chartered or other big banks that are involved, there's always multi-jurisdiction. There are always multiple creditors in different jurisdictions, entities all over the place, and complex situations like that require a more coordinated approach under one, I think. So just continuing to say, okay, we need to develop a bankruptcy law, well, we can, but it will take 10 or 15 years before that's been tested enough in the courts to be accepted by all creditors. And until then, people are looking for a different model, and they're trying to apply Western bankruptcy rules here. Sorry, convoluted answer, and I can spend many, many hours on this because I'm actually in the thick of those 2 or 3 situations. Sure. But that's where I stand right now on it.
No, thanks so much, Abdul Wahab. So, I mean, I think it has given some color to the whole bankruptcy situation. I think we'll probably, before we go on to any audience questions, I just wanted to have a couple of points from each one of you on the panel to give us a sense of, maybe 1 or 2 opportunities and 1 or 2 challenges that you see in the medium term the region is going to face. Just summary points, and then we can probably try to conclude this session. Over to you, Magellan, first.
I think the challenges are clear regarding decrease in tourism, a shifting in the expat communities. So I think one needs to keep that in mind and then accept that that's going to happen. But then, as we all know the proverb, challenges are opportunities. So I think where we see the opportunities is to make sure that you move extremely fast and faster than you've ever moved before to grab a hold of these changes. You know what I mean? So for example, July and August, normally for our businesses and consumer-facing businesses, is usually slow month. Expats all go to Europe or go back to whatever countries they came from, you know what I mean? And this summer, it's an opportunity for us. Those expats are going to be there. We're going to grab a hold of them. We're going to be selling them products and services, and it's a completely different shift. You know what I mean? That's an opportunity we've come. So some of these changes and shifts have driven opportunities. In our coffee business, as I mentioned earlier, it's doing extremely well. Why? Because some people are out of a job. Some people are on furlough. Some people prefer to go for a coffee, which is boiled water, versus going to a restaurant at this stage. So it's completely shifted all that. So I can go on and on with examples. So I think these challenges can be changed into opportunities, but you have to get into the minute detail. So those are my thoughts.
Sure, thanks. Ganesh, from your perspective, being one of the older bankers in the region here.
I would like to focus on a couple of opportunities, leave aside what's happening currently, especially sort of in the UAE. In the medium term, there is so much connectivity now between the UAE and Africa. So, given I cover both the regions as well, Dubai especially acts as a gateway into Africa. The kind of infrastructure, the kind of, flight connectivity we have. A lot of African companies I see are setting up regional treasury centers, buying arms out of UAE and specifically in Dubai. So that has helped up, open up a lot of opportunities for us to connect sort of, our customers from Africa into say Asia or sort of, India or, so on and so forth. On the Asia front, it's probably too premature to talk, but so far we've always talked about only Hong Kong and Singapore as the sort of centers. But given sort of what is happening recently between Hong Kong and China, and who knows the fallout from that, but the new security law and the associated sort of politics around it, the UAE or sort of specifically can try and reposition also as one of, as a competing sort of destination hub in addition to being, in addition to Singapore, because a lot of the companies may not find Hong Kong that sort of comfortable as a place what they used to find in the past. Those are the two things.
Thanks, Ganesh. Abdul Wahab, your comments on opportunities and challenges?
Yeah, just parting comments are challenges, like we said, are well known, but the opportunities for me are cautious optimism in the medium term. What are we going to do in the short term now to reach that medium term? And I think there's a lot of opportunity across the region. We talk about Saudi in development mode. UAE, like Ganesh said, is a good place to do business. Notwithstanding all of the macroeconomic issues it's facing, it's a place to look at forward. And I think you will see a lot of government input and stimulus coming through, and that needs to be taken advantage of. So it's my parting message is cautious optimism and a lot of planning for the medium term.
Sure. Thanks, all of you. And I just want to give a pause if there are any questions. If my colleagues are posting any questions, if not, then yes, I think we don't have questions. Unfortunately, probably we've covered a lot and we are also running out of time. So gentlemen, thank you so much, each of you, Magellan, Ganesh and Abdul Wahab, for spending over an hour and a half with us on this. I think you've given a lot of positive thoughts to a lot of the listeners, audiences who are sitting in the Middle East region, thinking about their fate as employees or even people outside like us who are trying to bring investments into the region. I think it's clearly all three of you are echoing that there are more opportunities and less of challenges. Challenges are there, but they can definitely be overcome by good planning, being conservative, and having the right kind of strategy in place. So thank you so much, all three of you, again for being with RBSA's webinar on this evening. Thank you so much.
Thank you.
Cheers.
Thank you. Bye bye.
Thank you.
Bye.
Thanks. Bye.